I think we are certainly seeing some stickiness of inflation in the United States, especially in the services sector. And that can be well explained by the fact that services depend intimately on wage inflation. And so if we have, as now, a relatively tight labor market with low unemployment rates, then wage inflation tends to be prevalent and impact services inflation. However, the last labor market report has shown that the economy is already creating less jobs than what was expected in the last months. And when we look how this translates on the unemployment rate has been slightly rising. So if this trend is continuing over the next few months, services inflation is likely to react to it and also gradually come down. As far as goods inflation is concerned, there is no concern to have. Goods inflation in the United States, in many other geographies, has really normalized already. So it's all about services, it's all about the labor market. And we do think that keeping cost of capital high, as the Federal Reserve has done now for a long time, is certainly going to impact on the plans of companies with respect to their personnel. And we are already seeing some very high-profile companies in the United States, in other places, really trimming down the number of jobs and employees that they're having. So I do expect that there is going to be inflation coming down as a result in the services sector. I think the risk of a stagflationary scenario is probably at the low end, unless we get major surprises that drive inflation again up. At the moment, it's not part of our base case expectation.